Welcome, everybody. Welcome to our Candid Coffee this morning. We so appreciate you being here today. When I started Candid Coffee, it was to really give everybody a voice and just to sit around and talk about what's going on in the markets. So definitely, we saw, I don't know who saw Lance yesterday on Charles Payne, flew to New York, looked very nice. Haven't seen him in a suit in a while. Thought it was somebody's funeral, but it wasn't. And I'm here with Mike Lebowitz,
Hello.
Fed guru.
For whatever that's worth.
I tell everybody, there's nobody who knows the Fed, even what's his name over there at that Wall Street Journal, better than you.
Is that a good thing or bad thing?
Nick Timmeros. I don't know. I'm sure it'll shorten your life.
My wife is certainly not impressed by that, but if it impresses you, that's great.
I should be impressed with that. How could she not be? Talking about interest rates and QT, and maybe in her world, quantitative tightening means a nice hug. Got to give her a hug.
There you go. I'll try that out. There's too much quantitative easing.
But there are a lot of things you all could do this morning, and you're here with us. So we really appreciate you being with us today. We have a lot of questions, but I wanted Mike to go over a few things. One is yesterday's employment numbers sort of took everybody for a surprise, right? We've been hearing the recession word all over the place. And we know one thing, recessions don't come when everybody's expecting them. That's a Lance line that I love more than anything. So I'd like for you to comment a little about that. And I know we have a Fed meeting next week, Mike. Just give us just an overview before we go ahead and get to the questions. Yes, Stan, he is the bond whisperer.
The numbers were fine. They came in at 100, I think it was 177,000 new jobs. That was a little better than expected, which was great, but they revised the prior months down by more. So we're kind of running in that 1.25 to 175 range, which is slightly slow, but normal. We're not showing this sharp drop into a recession. That's the good news. The data is slightly weakening, and we're seeing it in other employment data, but it's far from recessionary. So when you kind of think about the Fed and what does that mean, they have two goals. One is to keep the unemployment rate very low, and the other is to keep prices stable. Stable doesn't mean it's zero. Stable in their minds is 2%. So, we know that unemployment for now is fine. I think it's a concern of the Fed. And we also know that prices are rapidly becoming stable in their mind. Again, prices aren't going back to 2020 levels, but they're only growing slightly more than 2%. And we saw that in CPI, PPI, and then PCE last week, which is the Fed's indicator. So the Fed meets on Wednesday of this week. They're not going to cut rates barring some disaster between now and Wednesday. What they may do is cut QT because, as Lance has talked a lot about the basis trade, that points to liquidity problems in the markets. So I think from a liquidity perspective, you used to be able to drive there was so much liquidity, you could drive a semi over this ice and it wouldn't crack. Now we're worried that there's a lot less liquidity, so you're skating on thin ice. Doesn't mean you can't keep skating, but it won't take much to create a liquidity problem. And we saw some touches of that a few weeks ago. So I think the Fed cuts QT, or if nothing else, talks about cutting it at a future date. And then I think the big question for the market is, do they set the table for a rate cut as early as June? We did see some Fed speakers, Beth Hammack and I forgot the name of the other Fed speaker, that kind of laid the groundwork for what it would take. And I think what it would take is no jump in inflation because of tariffs and continued weakness in employment.
Riddle me this, bond man. PCE is what, year over year, 2.3%?
Yes.
Slightly above their target.
But it was 0%. So Rich, you're good at math. Annualized 0%.
Oh, duh. Right, I get that. But the point I'm trying to make is, what was the catalyst to cut rates last year when you had higher inflation, and pretty much met your unemployment mandate. You met that mandate, but at the same time, I feel like they aggressively cut rates last year, but I can't figure out why they would have done that.
So there's obviously the potential for a political angle, and given the blue and red dogs, I'm just going to stay in the middle and not touch it. So the one thing to consider is that rates were way too high where they were at 4.75% for an economy that's growing and should grow around 2%. So they should have been cutting rates. They were aggressive. It was before the election, and we can debate why they did that all day. And to tell you the truth, it doesn't matter. And I honestly think they would be cutting rates today if this tariff thing wasn't here. I think they're scared that tariffs will create inflation, and that's what kind of keeps them handcuffed. Otherwise, I think they would be cutting rates. I think they got probably a little too aggressive last year, and they should have been cutting 25, taking a meeting off 25, and they keep going at that pace, and we'd probably be close to where we're at today. But they still think rates are too high, but tariffs are what's kind of keeping them up at night.
They're not reading your work where tariffs could be disinflationary, right?
Well,
we don't have the same pricing power that we did before. And I was listening to the Walmart conference call, and the CFO was talking about that they don't have the ability to pass price increases on to the base. They might have to eat it in the form of margins.
And what's interesting is McDonald's, Starbucks, Chipotle all said the same thing. And those are, so I think where inflation has finally caught up with consumer behaviors is the very kind of low end of the market. And but the problem is those are people that spend 100% of what they make. So in some ways, they're the marginal driver of spending. And so it's telling. It doesn't mean we're going into a recession or depression. It means that their pricing power is gone, at least for some of those companies, which means their margins are going to become problematic, potentially, if this continues. And if layoffs happen, it's just going to get worse.
So let's, and I appreciate that. So let's get to some of the questions. One of the questions obviously has to do with our short position and a way for us to hedge the portfolio, because generally speaking, and I'll let you really expand on this, generally in these kinds of markets, you do get another leg down. So, and I want to talk a little bit about that. And I also want to talk about people that really made this all in, all out decision at Liberation Day and were freaking out, and we were telling them not to do that, right? There was a way to scale out a market surgically as opposed to taking a machete to the portfolio. And then talk a little bit about, I'm not a big fan of HELO versus the SH, but maybe you want to expand on that. So the short position, let's go a little bit into that, and why SH would be a better play than HELO, and why are we doing it anyway if markets have recovered or maybe if surpassed Liberation Day, derail.
Right. So let me, I'm going to add a graph here. I assume you can see it. It was actually from Friday morning. So we're up slightly more since then. But this is, kind of the market since, about the last year, 6 months. And you can see it was dropping. And then Liberation Day really fell off a cliff. We hit a low, we bounced back, and when we were post-Liberation Day, we were very oversold already. And that just made it kind of not, I hate to use the word historical, but historically oversold. Even if we were going into are going into a depression, the market was grossly oversold at that point and was going to bounce. It was just a question of when. So we wanted to reduce exposure. Our long-term indicators finally triggered and said, you need to reduce exposure, but we didn't panic and do it at the bottom. We waited. We knew there was a bounce coming. The risk was the bounce was 5%, and then it was just going to continue lower. And so what we do is we kind of have these risk-reward matrix, and we understand that the bounce could be 5%, 10%. It could, there's various ranges. So if you look at the graph, this is kind of what helped us gauge where those potential turning points are. And you can see the various moving averages. The 20-day average was kind of the bottom, I guess, what is that, red line? that was kind of the first point. We're like, hopefully we get through here. This is kind of the first point. And then you got that dotted line. And the significance to that is that if you look as we were falling, it acted as support a couple times. Interestingly, if you measure the difference between the top and the bottom, that's the halfway point. So it's called Fibonacci analysis, and we're not going to bore you to death here, but that's also an important point that tends to be support or resistance. And we went right through that. And now you can see we're through the 50-day moving average, and we're coming up against the 200-day in black and the 100-day in yellow. Those are probably where this thing stalls out, and potentially we head back down, and from that point on, it's, we'll see what happens, because it's not just technical. It's what happens with the economy, what happens with tariffs, and probably three other things that we aren't even thinking about yet. But, most times you test a bottom. So, what I think is going to happen is that we're on a roller coaster. We kind of said, Lance and I both said this in different ways at the beginning of the year, what to expect this year. I think we're going to be on a roller coaster where we start and end at the same point, but we're going to be giggling and throwing up along the way, because it's going to be scary and exhilarating. So, I think we're probably going to revisit that low, rally again, and depend. So there's, obviously tariffs are a big deal for trade. But I think the problem that we have now is that this consumer sentiment, corporate executive sentiment is very poor. And the longer that continues, the more economic damage occurs.
Yeah.
So
that
the
soft data becomes hard data, right? Because your animal spirits aren't good. So the hard data is coming in fairly good across the board. But
it's delayed. Right. The problem with hard data is it's delayed. It just takes a while to compile the data. So we just got earnings. That's great that they were good, but that was January, February, and March. What's going to be more important are earnings for the next 3 months, which we're not going to get till late July. What's important is going to be the jobs number in probably June, July, August, the inflation numbers. So somewhat in May, but mainly June and beyond is where we're going to see, did people decide not to go to dinner, and did they decide to cancel a trip and postpone buying a car because they're worried about tariffs? Now the flip side to that, Rich, is that some people went ahead and bought in advance. So for instance, I need to get a new phone. And I was thinking, I didn't do anything because I don't know why, but I was thinking I should go buy it now because of tariffs. And I didn't do anything, but the thought crossed my mind. Same with a car. I have to buy my son a used car. I was thinking maybe I should buy it now before tariff raises new car prices, making demand for used car prices higher. So I think it's all in our mindset. How can we save a lot, regardless of whether tariffs are inflationary or deflationary? People think it's inflationary, which makes sense, right? If you're going to raise the price of something 20%, why wouldn't the price go up 20%? And we could debate that all day. But so we had this pent up demand flow through the system. That's why GDP was negative, even though it really, it was, but it's not as bad as it sounds. So now people probably consume more than they would have in the first quarter. So we'll see some let up in demand in the second quarter, and then the economic effect. And that's what I think is really going to steer the market. And whether we go to new highs, whether we kind of ride the roller coaster up and down for the next 3, 6, 9 months, or whether we go look more like 2022, where we're just constantly hitting lower lows and lower highs. My guess is the roller coaster, but until we know more, we won't know more, so to speak.
I think with the short position and the additional cash as we've pulled back equities, it really showcases one of the reasons why I truly appreciate why we did it was these forward-looking numbers that we're concerned about, not these backward-looking numbers. That soft data, you are already hearing of the great article in the Wall Street Journal today. Really good one about how people are holding back, how we're seeing travel, number of seats not being sold in airplanes, and all of this because people are waiting. and they want to see. So this kind of behavior eventually should show up in the hard numbers. But it's great that the market's recovered. But you're going to be on this roller coaster. So in our portfolios, we might see more strategic trading. Last year, we didn't do very much, but this year, we're going to be more tactical, and that's just the way it is. Now, the difference between an SH and a HELO, maybe someone had asked that question, David, I think. So I don't see a reason for us to own HELO, but maybe you want to talk a little bit about the differences between our pure short position and that ETF HELO.
Yeah, so someone asked a question, why use SH instead of HELO? HELO is, I believe it's JP Morgan. It's called an ETF hedged portfolio. I don't have the exact name right, but that's the gist of it. What it is a portfolio of stocks with hedges in place. So what they are trying to do is somewhat what we're trying to do. We have a portfolio of stocks and we hedge that portfolio of stocks various ways. We can just sell stocks and sit on cash. We can reallocate stocks, so we can sell a high beta stock, a stock that moves up and down, that exhibits a lot of volatility, for like a utility or a Procter and Gamble staple type of company that doesn't move very much, or that sometimes even goes up in a down market. Or we can just add short exposure via an ETF like SH. So SH is just the inverse of the S&P. If the S&P goes up 2, SH will go down 2, and vice versa. So for our purposes, SH is what we want. We're just trying to reduce exposure. If you look at year-to-date returns, SH is up. I looked a couple of days ago, it was up like 2%, 2.5%. HELO is down 3% year-to-date, and the S&P is down 3% year-to-date. So HELO certainly may have a purpose for some investors, but it just doesn't really hedge in the same way. If you want to, you can use HELO as your portfolio, and what you'll see is returns that may be probably S&P less something, but the downside is also limited. So it'll be a more conservative version of the S&P 500. That is, if that's what we wanted to do, we would just buy 100% of HELO for every customer and call it a day. Life would be easy. But we prefer to use all our different tools to hedge in a way to maximize the returns.
I think HELO, to your point, is for someone who's not doing the actual hedging themselves, like we are in our portfolios. If you just want to own HELO because you don't like the volatility of the S&P 500, or you want to hedge your market bet, that might be fine for you. A lot of this stuff is marketing gimmicks to me. We have a pure hedge because we manage a portfolio and we added a short position in there. If we get what you're saying, if the soft data becomes hard data and it's not very good, like you said, I think the summer is really going to be what's going on. Summer into the following quarter, are we really going to see a slowdown? Not recession, perhaps, but a slowdown. And that's where markets might be really surprised. You take that another leg down, that is probably when you start releasing some of that SH, right? That's when we start to actually maybe start trimming it away. If we test that bottom, we might decide that now is a good time to actually remove it after a period of time.
Or, so again, we have 3 tools. We could decide, we're going to get rid of SH and we're just going to sell more of the stocks we own. Mm-hmm. So the way we think about it is, what's the volatility of each stock compared to the market? And then how much stock do we own? So when we buy, say, 5% of SH, that's like actually owning negative 5% of the S&P 500. So if we have 50%, we actually have, so if we have 50% in stocks and 5% in SH, we have 45% exposure to the market. And that's kind of about where our current situation is. But we could get down to 30% and say we just don't want to buy 20% of SH. We're just going to cut a third off every stock or something like that. Or we're going to get rid of all the tech stocks, all the communication stocks, and we're going to load up on Duke Energy and Procter and Gamble and Johnson and Johnson and maybe add more bonds. I mean, so there's many ways to skin that cat to reduce exposure and many ways to add exposure.
You know what I love about this market this year? The clients, when I say that, they get real quiet on me because they say there's like absolutely nothing to love. Last year, Magnificent Seven, the rest of the market is a dead zone. This year, you've got to be a good stock picker. This year, you're earning your keep. Last year, we could have sat on the beach with what we had, and I know we beat the S&P, and that's not really relevant. You really should have your own benchmark index based on your financial plan. But the point I'm making is this year, when you start to isolate out, it's not as bad as the media makes it to be, Mike. It's not
Right.
as when we were going through that downward spiral, the bombastic headlines that were out there, pretty much helping people to make very bad decisions with their portfolio. Now you don't hear anything that the market's recovered.
So Rich, this is a very important point. And I talked to when I was on YouTube or radio with Lance on Thursday, I brought this up. Lance and I both write a lot of articles on our behavioral traits. And we do that to educate. We also do it for ourselves.
Yes.
I wrote the last one for myself. I was being greedy. It wasn't for you guys. It was for me. Because when I have to take the time and relearn some of those traits that work against us, it is extremely helpful for me when the market's dropping 4% a day for 3 days in a row to just stay cool, not let my gut say, let's just sell everything and wait to see the smoke clears. Because historically, history has proven time and time again, very oversold conditions cannot stay very oversold for very long. They will bounce. You will get a bounce. We didn't know whether it was going to be a 5% bounce or a 15% bounce or whatever it was going to be. So you have to learn to kind of get rid of those behavioral traits that you have that, I mean, think about it. It's so ridiculous. When the market's screaming higher, right? When prices are at all-time highs, everyone wants to buy. When they're getting cut in half, no one wants to buy. They want to sell. If you go to the grocery store and I didn't see lines trying to buy eggs because eggs were $12 a carton. People started substituting. They didn't want to buy eggs. But if eggs are 50 cents, everyone wants to buy them. But that behavior doesn't exist. It's the opposite behavior in the stock market. It's, and that's our behaviors, our mindset working against us. So
yeah,
keep
I
your
mean, we
plan.
had a real egg fetish there for a while. How many eggs are you all eating? I mean, it seems like you only eat eggs. I mean, now that eggs are they're sort of back to normal, but now we don't hear about it. So I think you got to be real careful of mainstream legacy media when it comes to financial headlines. They seem to want a recession. They seem to want the downturn, and you now have to step away from that. When I talk to clients and I go through their portfolios with them and they go, gosh, I thought I would be down more. I'm like, you got to get out of the media. That is not going to help any kind of behavioral bias that you have. It's just not.
Right.
Because
And it's
let's put it this way, if I was a Trump voter, I'm very overconfident and I think tariffs are going to work and all that. If I'm not, then I'm frightened to death. I mean, either way, if I'm getting influenced by politics in my investments, I could make a very, very bad mistake.
that's a huge point. Drop your political bias. Doesn't matter whether you love Trump or hate Trump or you're right in the middle like me. You have to forget it. You can hate Trump and love his policies or vice versa, but you have to think about how his policies, whether you like them or not, will affect corporate bottom lines, consumer spending, global affairs, and all of that, and put it in. So, for instance, tariffs are not the greatest thing. They're a tax on the economy, on the global economy. But if we end up at a point where every country's tariffs on us were cut in half and we don't have any new tariffs on them, that's a huge win. That's a huge win for the USA, and that's a huge win for the global economy. Then you also have all his other deregulation, lower taxes. So there's some really positives out there that, assuming he can control, kind of maintain Congress and get the votes, there's really a lot of potential economic stimulus isn't the right word, but a lot of economic turbo power in the engine. So again, drop your biases at the door when you're investing. You can go to a cocktail party, talk politics all you want, but when you're dealing with markets, you have to drop it at the door, front door, leave it there.
Absolutely. Absolutely. What about, we have some questions on gold and petroleum. Give us some of your thoughts. I know gold has been an all-star this year, but and we have our all-weather portfolio that has a pretty good sampling of those investments that have done very well this year. But maybe you
Right.
want
And we actually, about a week ago, I think it was, we trimmed back our gold back to its model weight. So we took profits in gold. We didn't reduce it below our model weight, but we just took profits. And that model's a little different. It's called the all weather because it's kind of meant to hold up in all types of market weathers. So in this instance, bonds were doing, actually this year, bond yields are down about 30, 40 basis points, but
Right.
let's just say they were very volatile. Stocks were very volatile. And gold was kind of that third leg of the stool that was holding the whole stool up. So the problem with gold is it got very overbought. Right? Forget fundamentals. It was just grossly overbought, just like the stock market was grossly oversold. It was due to come back. It was almost 3 to 4 standard deviations above its moving averages. It was just getting way overdone. It's coming back now. It's down, what, $150, maybe 200, something like that. Not coincidentally, but the dollar has stabilized. It started gaining a little ground. The other markets are doing better, stocks, bonds, etc., Bitcoin even. So, the money, the fear trade was chasing gold. It could have been Bitcoin. It could have been utility stocks. It could have been treasuries. It was gold. And, some of the geopolitical nature of this probably favors gold over some of those. But as kind of market tensions have simmered down, the air is coming out of the gold bubble. So it doesn't look, I'm not saying gold can't go to 5,000 an ounce. I'm just saying it's still very oversold and is due to come down more. And if we go back, if all of a sudden Trump comes out today and says, you know what, screw it, those 90-day suspensions are gone, everyone's getting tariffed 50%, gold will be at 4,000, or, maybe not 4,000, but you get the drift.
Get your point. Yes, I get your point.
So gold has a place in a portfolio as a kind of insurance policy.
Yeah, and Bitcoin is not that insurance policy. Let's be clear.
What's that?
Bitcoin's a risk asset. Any kind of cryptocurrency, which I'm okay with. I own it myself, but I understand that when there's risk on, that's when my crypto is going to do better.
Well, what's interesting, I just ran some analysis for myself yesterday, fooling around, and there's really no relationship between gold and Bitcoin, which I thought they're both alternative currencies. They don't kind of go together, which you would think they would, especially in times like this. But Bitcoin was falling right with stocks and bonds and everything else. It was actually trading like a traditional asset. Gold was trading like the pure hedge. So
I hear a lot of talk about bonds and that bonds are terrible. No one's going to believe in the United States anymore. It's all trashed, compared to unless you study other countries, which people don't. They just think that we used to think we're the cleanest dirty shirt, and now we're thinking that the whole world order is going to change and the dollar is going to be gone. Bonds, U.S. Treasury bonds, no good. But when you have bonds in your portfolio, I know our bond portfolio is up over 2% this year. And in a 60-40 model, if you just followed a domestic model, you're down about 0.5% this year overall. But bonds have definitely been a safe haven to a great degree. So maybe you want to talk about this whole narrative that bonds are dead and yields are going to go through the roof and all that kind of thing, which we
right, that's the fear narrative. So I think you got to start this conversation at a very macro level. The dollar is the world's reserve currency. When Peru wants to trade with Indonesia, they're using dollars. Neither country wants, Indonesia doesn't want Peruvian, what are they, pesos, whatever Peru uses, and vice versa. They have no use for them. They want US dollars. because they can keep US dollars in a bank that they trust. They can invest the US dollars. And where do they invest them? In the treasury market for the most part. So what does the US have? First of all, the largest military in the world. We have the rule of law. We have far and away the most liquid capital markets, and it's not even close. These countries can easily borrow in dollars because of our markets are so liquid. So there's no alternative. I know everyone likes to say, well, the Chinese yuan or Bitcoin or gold or this or that. There's no alternative. And it's not to say our shirt isn't getting dirtier. It is, but it's still far and away the cleanest shirt in that stinky hamper. So because there's a need for dollars, there's a need for bonds. There's also a lot of portfolio managers that run 60-40, 70-30, 80-20, 20-80 portfolios. Bonds are, like I was talking about the three-legged stool, they are an essential part. And they do provide fixed income. You can buy a bond today at 5%. And if you're just looking to earn 5% a year for the next 10 years, you can lock that in. That's not that bad of a deal. There's endowments, pension funds, life insurance companies, sovereign wealth funds that have to own bonds. They don't have a choice. There's money market funds that only own short-term bonds. There's fixed income mutual funds that only own certain types of bonds. So there are so many players, and I think it's not like the stock market where the stock market S&P could go down where the price of Nvidia could be cut to 50, or the S&P can go down to 3,000. If the bond market goes up to 6%, 7%, we're in a depression. It's extremely linked to the economy. We are a highly leveraged economy. The Fed will not let rates that go that high. But you know what? It's not really going to matter about the Fed, because every insurance company, every endowment fund, a ton of investors will start buying bonds at 4 3/4, at 5, at 5 1/4, at 7. I'm just going to take everything I got and buy bonds, because I'll take 7% for the next 30 years and I'm done.
I'm done. Right. If you're getting 6% on bonds, that should be telling you that your GDP is steamrolling, right?
Right.
You don't have the negative macro trends of demographics that are terrible across the globe. You don't have this lack of productivity and Gen Z that doesn't want to leave the house and work. So, I mean, in other words, we have a lot of other headwinds that prevent those yields, unless it's just a lack of faith or confidence. But I am with you. So bonds are still an important part of your portfolio.
They're frustrating, but unlike a stock that goes nowhere, you're getting 4 or 5% every year to be frustrated. There's worse ways to be frustrated.
Same thing if I'm sitting on cash. I am still a kid in a candy store. There's less candy. Maybe there's more of those Mary Janes, which I never liked, right?
Get stuck to your teeth.
It's stuck to your teeth, stuck to everything, stuck to the dog, right? I mean, that's where I think they got super glue. But if you have cash, you can go to I prefer high yield savings accounts like Marcus. You're getting 3.75% on your cash. I can roll treasury bills, right? I can buy CDs. In other words, if I am a saver, these are still good rates, Mike. I'm still okay with sitting there frustrated at 4.1, 4.2%, or even a 12-month CD at 4.5%. I'm okay with that. So if you have some cash and you're hesitant in the market, go ahead and look at different Marcus Bank, Synchrony Bank, Discover Bank. They're FDIC insured. I use them. I never had a problem with service. I don't want to pay for the brick and mortar at JP Morgan, and they're not going to pay me anyway. And they're going to try to sell me something I don't need, which I don't want to. So there's a place for cash. If you're using cash because you're trying to time the market, that's a totally different story. But we had some questions about what do I do with cash right now? And I'm like, you still have multiple options when it comes to investing cash. Sometimes we use Bill, which is the ETF, right? I think that yields over 4%.
Right. That yields. It's pretty much owning treasury bills, but without the hassle of having to buy them, let them mature, and buying new ones. I use it for my kids with their cash. They just sit in BIL. When clients say, "What do?" I tell them BIL. Friends, I just think it's an easy way to own treasury bills versus because most people don't know how treasury bills work, how to buy them, what the price and yield, and how that works. So just let the professionals do it. They charge a very low expense ratio. Money market funds, if you're in the right money market funds, and doesn't mean every money market fund pays 4-ish% because some don't. But if you're in the right money market fund, those are fine. Treasury bills are fine if you want to be a little more sophisticated. Banks are not going to pay you for the money. There are, however, some CDs that will. And I know my father-in-law used to do this. If you go to like the local banks, the very, where they have 3 branch type banks, they put out what's called teaser CDs. So they may give you 6% for a year, because even though they're paying an above market rate, they know that a lot of that money is sticky. So when the year comes up, you're going to keep the money in their bank, and then they can start making money off you. So there's a ton of options to cash.
Walter's bringing it up right now. You have Treasury Direct, 4-week T-bills, real easy. Actually, you can buy T-bills through Fidelity.
Sure.
I mean, again, you have a whole bunch. You have choices today. I don't know how long that lasts, but for now, you do have choices. Listen, the government makes everything difficult. Treasury Direct actually works pretty well for that. So someone asked about, and then we'll get into some of the financial planning. We have some Social Security questions and stuff like that. Someone asked about our sell discipline, a little bit about that. Maybe you want to explain. What I always tell everybody is that we have multiple layers of selling. I call it the Thanksgiving Day oven. We have an oven that the positions bake in. And when that oven gets too hot, we pull some of that out because it's overbought. It's heated up. We did that when the technology oven was way overheated last year, right? So we have boundaries around each of these positions. Then we have a wholesale way of looking at it, depending on where we are, to actually extract money out of the market, but it's all based on rules. There is no emotion in the process.
So here's a great example. We own Palantir. We think the company is really set up for a bright future. It got hit. It's a high beta stock, meaning it's going to move more than the market. So when the market really started trading down, it got hit hard. We added to it. Well, we were subtracting other stuff, but we added to that. That was one of the things we added to, and we brought it up to 3%. It has outperformed the market decently during this downturn and now in the upturn. So if you look at our portfolio now, even though we bought it at one point, whenever that was, called 6 weeks ago, to a 3% position, it's baked in the oven. It's now a 4% position because other things have dropped in value and it's gaining in value. It becomes a bigger share of the portfolio. So now we have a question. One thing we can do is, if we think that it's overbought and due to either consolidate or kind of just normalize here, we can just sell it back to model. So we could sell it from 4% to 3%, take some profits, and maintain our model weight. And last year we were doing that all the time. We'd say, oh, Microsoft and Apple, or once again, they're supposed to be 4%. Now they grew to 4.5% because they've been outperforming everything. Let's just sell 6 shares and bring it right back down. So we're doing that all the time. And then on the flip side, we have stop losses. When a stock is just breaking down, and sometimes they're oversold, but there's potential to be much more oversold, we're saying, you know what, enough. Or if there are companies that just can't get out of their own way. Right. CVS used to be one of them till we sold it. Now it's not anymore. UNH is another one. They just, it's just the industry they're in and some of the things they're up against, and you just have to know when to get out and call it a day and maybe get back in the future. So having a buy discipline is important, and having a sell discipline is equally important.
It's been fun spinning those 3 plates of let's lower overall exposure, let's increase some positions, right? And then add a short.
Juggling.
You and Lance are like Lucy and Ethel on the chocolate conveyor belt. Speed it up a little, and the chocolate keeps
Right.
coming. Yeah. So that's what we do. So there we've got, again, what we do is also holistic financial planning. We've got a lot of really great questions, especially on Social Security and so forth. And I got a question on, I don't know if you ever heard of this, Mike, called 72T, but there's a way around the 10% premature distribution penalty if you're under 59 and a half. So it was a sort of a strange question because it said, why can't I just do that where I'm going to amortize part of my portfolio to minimize my IRA portfolio, or I'm severed from service and it's my 401k. I'm gone from service. I separated, and I set up this ongoing income stream. Why should I do that instead of Roth conversion? Why shouldn't I do that? Well, let me explain. If I'm doing a 72T to take money out of my accounts, I am desperate for cash flow. That's what a 72D is there for. It allows you to create a formula and stay with that formula for the greater of 59 and a half or 5 years. And you're able to go ahead and with at least immunize yourself from the 10% premature distribution penalty. It could be very substantial for people who need cash flow in retirement and they're under 59 and a half. Totally get it. But if I'm doing a Roth conversion, if I'm moving money from pre-tax to post-tax, it's because I understand where my tax brackets are going to be in the future, and or I have a legacy intent for non-spouse, right? If I go ahead and have, like Mike has his children, he lists his children as beneficiaries on his IRA and something happens to him, they have to take that money out over 10 years, which means he could be putting them in a precarious tax situation. If they're in Roth, yeah, they still have to take it out over a 10-year period, but it's completely tax-free. So it's a little bit like apples and oranges. We come up with distribution strategies that are tax effective. Someone mentioned about, which was great in the questions, diversification of accounts. This is what we always talk about, because think about it, Mike. What have we always been told for as long as you and I have been in this business? Always have all your money in pre-tax. Then when you, right, because when you retire, you're going to fall to the lowest tax bracket.
That's the assumption.
That's the assumption. And that's not including the fact that I might be taxed on my Social Security income and be subject to premiums above my base premium for Medicare. There are a lot of these backdoor taxes that are not told. And years ago, when I first started in the early 90s, people did fall into the lowest tax bracket. They don't anymore, especially when my Social Security is taxed. So if I'm doing a 72T, it's because I need a paycheck from my retirement accounts, and I am a spry 57-year-old and I have no other cash. This is how I got to do it. That could work. There's a process to do it. You just don't want to go ahead and do it. If I'm moving from pre-tax to Roth, that's a tax strategy and a strategy for later income down the road, which is totally different. There's not one that's better than the other. Either I need cash flow or I don't. So 72T, we don't use it very often, but it is out there and it has a few methods of calculating how much of a paycheck that you would get from an account. And all you're trying to do with 72T is avoid the 10% premature distribution penalty. That's what you want to do.
So I think, Rich, kind of what you're saying here is that there's a lot of options to achieve whatever it is you're trying to achieve. And this is when you want to talk to a professional that understands all 3, 4, 5, 7 options so that you can maximize your wealth, meet your needs, whatever those needs are today, but ensure that you have money, when you're 70 or 80 or, hopefully longer.
Tax brackets, and again, the whole turmoil, Mike, of the Tax Cuts and Jobs Act. I don't know if Trump has the political clout to get in this tax bill right now with the way tariffs have worked. Maybe the market will save him. I'm not sure. Either way, it's going to look a little bit different than the previous. And we have these 22 and 24% marginal rates brackets that are really wide, and it allows people to do these Roth conversions. We'll see how that changes. So far, I don't have it in our planning software to sunset. So when we help people create paychecks in retirement, we craft it to where it might be taxable, tax-free, like in Roth, and tax deferred. And we're trying to manage within the tax bracket, including taxation on Social Security. I think Kathy asked about taxation on Social Security. How do you avoid it? Let me tell you, it's very tough, Kathy. That provisional income formula is very tough. Okay. I don't know anybody who can avoid it. If you're single and you have $32,000 in modified adjusted gross income or provisional income, you can do it. But almost everybody's getting taxed. The people that have a lot of money in retirement, and I mean they're above 50,000, they're going to get taxed at 85% on their Social Security. The ones below, they're not getting taxed at all, but you got to hit these thresholds that haven't been indexed since they started. So the people in the middle, if I'm taking out $50,000, $60,000 of retirement income from my IRAs and so forth, it's inevitable that I am going to fall off this tax cliff when it comes to taxation on Social Security. And that's why we have to figure out a person's real marginal tax rate versus their bracket. Because I can show somebody in the 12% bracket that you're not in 12%. You may be in the 12% marginal bracket, but you're paying about 16% at a marginal rate because of taxation on Social Security. So there's very little ways to do it. If Trump gets through his, no taxes on Social Security, that would help a lot of the middle Americans. That's who he's not going to help this group as much because they don't like paying taxes, but they can. This group they don't pay taxes, but the middle group, which is most Americans that may have between say 45 and 65,000 in retirement income a year. Yeah, he'll help them out a lot, but I don't know how you do that without raising the threshold on the wage base for payroll tax. Because the way the system is, I don't know how you not do one without the other.
And then the broader question is, okay, say he says no tax on Social Security. Where's he going to make that up? Is it going to be a tax on something else? It could be something unrelated to Social Medicare or Medicaid or who knows what. So it could hit you, even though you save on your Social Security, you get hit on a national sales tax, something else. So, you have to wait and see.
Well, because you have a wage-based limit for Social Security that's at $176,100. So you stop paying into the system at that. So to your point, Mike, he would look, and I haven't seen it, but you're going to have to raise that ceiling for anybody who's paying into Social Security to make that happen. To your point, someone else is going to pay. So I have people that are torn on this because they go, well, at least with payroll tax, it's paying Social Security. So at least I know where it's going. I don't have that much of a problem. But to your point, it's going to come from somewhere. And there's nothing about means testing. I checked the legislation, Chris, about means testing. There's nothing about mean testing in the process, which is great. There's no, I thought there would be, as far as like, if you have this amount of money in pre-tax IRA, you're going to be taxed. There's nothing. It's just a blanket across the board, cut taxes on Social Security. Who will pay are the earners. Those who are still working eventually will have to pay. I don't know. I don't see that in there, but that's what would happen. That's what would happen. So we got a really good question on that. So I don't know. Taxes on Social Security, Roth income, beautiful thing. Roth, I sounded like Trump there for a minute. Beautiful, huge.
Huge, beautiful.
Huge, beautiful Roth. No taxation on Social Security, no IRMA. It's as if you didn't even earn it. It doesn't go into the provisional income formula, which is beautiful. That's why also a lot of people switch to Roth, right? Is because of the fact that their Social Security won't be taxed. I have, you wouldn't believe, Mike, how many clients I have now that are pre-RMD, required minimum distribution, that have taken 7-figure IRAs and have moved them all to Roth.
It's so guaranteed income, guaranteed net income, right?
Tax-free completely, Social Security 100% not taxed.
Rich, I got a question for you.
Yeah.
if you're making contributions to a 401k, say you want to contribute 5% to a 401k and you have the option to do Roth or a regular 401k,
I'm
how
Roth
we
all day. I'm Roth all day.
you would do 100% Roth.
If I'm a younger worker and I know I'm going to be a high earner down the road, I'm going Roth.
What
Now
if
I'm
you're
in
a
my
high earner?
now I'm a high earner. What I might do is split it. So I'll go from full Roth to split, and then as I'm close to the end of my career, full Roth again. I will switch, but I will have two buckets of money. I'll have completely tax-free and pre-tax in my portfolio when I retire. But then there was a great article in the Wall Street Journal about these Roth converts. They won't do anything but Roth. Because there was a study out there from, her last name is Bashirs, but it doesn't get talked about a lot on Wall Street because they don't seem to like Roth very much. But it's a Harvard study that shows that even if you're in the 15% marginal rate, marginal tax bracket, that when this was written, you would still be better off in Roth than you were in traditional.
So is that all? So it's all your starting point, right? So if you were to start your retirement savings at the beginning of a bull market, the non-Roth is probably the better way to go. If you were to start at the beginning of like 1999, when the market's not really going to reach new highs again until 2010, you're not so it's your starting point too, and we never really know what that starting point is. So I think, to your point, diversify. That was your message earlier, but it's diversify your tax risk.
Were aggressive to convert during the inauguration day derail, which I love. We have trained a lot of those clients. Rich, look at this. This is the time. And I cannot tell you how many Roth conversions I did at that trough. And now I get that appreciation in the Roth.
Right.
The Roth IRA, you have to you could take if you're making a contributory Roth IRA every year, like my daughter does, she could take her contributions out at any time, but she's got to wait 5 years to take out the earnings. Roth IRAs have 1 5-year clock that goes for every Roth IRA. I'm not talking about a designated Roth account like your Roth 401k or anything like that. So yeah, you got a time frame, but you need to wait. But these are retirement accounts. That's how you got to look at them. And then the money will be completely tax-free. Okay. So Mike, I will tell you, we run the analysis on people who have done Roth conversions, 7-figure Roth conversion. They're already at the top rate. They're blowing it out that 1 year to do it, or we're timing it and looking where we're surgically doing it every year. So a lot of times in our program, it'll show you a front loading of Roth conversion. And then you're going to see it's level off. What we're trying to do is control IRMA, which is the charge on top of your base Part B and Part D premiums. So, we got to run the numbers to figure out what exactly is your Roth conversion strategy. Is it even right for you to do it? Right? If you are close to retirement and you're still working and you're high earner and you don't want to do Roth conversion, that's okay. Just, Mike, to your point, shut off the traditional IRA pre-tax and turn on the Roth.
That's probably probably one of the few times you don't want to do it, right? Is when you're paying the max rate and you're getting close to retiring and you're going to pay a lower rate.
It depends. It depends on what I want that asset. If that's a legacy asset and I'm going to let that sit for 30 years and it's based on the life expectancy of my kids, I might absorb the tax burden so they don't. It just depends on what you're using it for. But to your point, yes. But Roth, we've been talking about Roth for 10 years, and now all of a sudden with the Secure Act, it's the Rothification of America. Do you know next year, if you make over $145,000 and you make catch-up contributions, they have to be in Roth. The government needs money now. I call Roth the J.G. Wentworth of accounts, right? So I need the money now. So people go, oh my gosh, but Roth will be taken away. I'm like, the fatted calf on your farm is your pre-tax accounts. That's where all the money is. Maybe in 40, 50 years, Mike, they find a way for Roth, but that's not now. Now they want the money, which means do more Roth.
Another question, which I should know, but you're the CFP, I'm the CFA. What does Roth stand for?
That's named after the gentleman who,
Okay.
yeah. I thought you were going to stump me there for a minute.
I tried.
So, great question. Should the regular IRA side stay in conservative funds and Roth and growth? Well, if I could do one or two ways. I can go ahead and say I want my really aggressive stuff in Roth. I want my aggressive stuff in Roth, and I might even have some bond money in Roth because it's completely tax-free at the end, right? I might put some 5% bond, 4% bonds in there because it's going to be completely tax-free. But I am going to have a portion in there that's going to be aggressive growth, not equity income or anything along that. I'm going to keep that for my pre-tax IRA. So I want growth in my Roth, but I also want a good income stream because by the time that's ready to go, I'll have all that tax-free. Have any suggestions for minimizing the income tax and penalties for withdrawing earnings from 529 accounts? So do you have any 529 accounts? Did you have any 529s for your kids, Mike?
Very little, but we tore right through them.
Yep, Senator William Roth. Thanks, Larry.
They worked. I mean, it was a good deal, and they were tax deductible when I put the money in for the state of Maryland. So,
right, like you said, there's a state. You got to look at 529s very specifically by state as well. Are they direct owned or are they through brokers? What are the costs? Do you get a state income tax deduction? Right, that also figures in. I don't let the state income tax deduction drive my decision, but it's nice to know because sometimes
in Texas, it's not. It doesn't matter. But
no, it doesn't matter. But where you
matter.
are, it does.
But so the reason I kind of stopped early on, because their portfolio options stunk. Their fees were very high for very generic funds that I could pay 10 basis points in expenses. They cost like 1%. And I figured, yeah, it's nice getting that tax deductible, but I'm probably losing, or
money.
At best breaking even versus doing it on my own.
That's the point. So for a lot of clients that are in your area, in some areas of the Northeast, we let the state income tax deduction go. It's not worth it for the quality of the 529. Now, if you have 529s and your kid's like, I have a kid, she got all her, everything was paid for. I just pay a little bit of her rent. She's got money in her Roth. We've had it in the Roth for more than 15 years. I make Roth IRA contributions to her account from that 529 every year. There are very specific rules and it maxes out at 35,000, but it's a really nice option because I want her to have the money. But I move money from her 529 into her Roth every year. That's relatively new, but that might be a suggestion for you. So listen, we are here at the end. We have a lot of great questions still. I don't want to keep you going. What we're going to do is answer some of those questions on the radio. And that'll be something that we'll go through. I'll make sure we keep the questions. And then we'll have our next Candid Coffee, June 28th, Financial Freedom with Danny and Lance. I guess one of Lance's rules is when the kid turns 18, I get him out of the house. That's financial freedom for Lance. But that'll be a great one. Listen, there are so many things you could have done today in the morning, and I don't want to keep you. Hopefully it's a beautiful day where you are. But Mike, I really appreciate you being here with us today, just giving us some of your Fed insights. It'll be interesting to see what their will we get their, I guess, their Fed minutes next week.
They'll put their statement out on Wednesday. But I think, equally important, they'll start talking. They're in a media blackout. So when you get to Thursday, Friday, Monday of the following week, they'll start talking and they'll give you inside baseball Fed style. Okay.
Well, that'll be great. Well, we all appreciate you being here. Why are all the winners related to Rosso? I call a few friends in New York, they make it happen. And Michelle likes me. She doesn't say it. She calls me a pain, but she likes me.
Keep thinking that.
I got to think it, otherwise I don't live.
Not what she tells me, but whatever.
Thanks, Mike. Thanks all to our great guests.
Yep.
Glad you got the mugs. Any other topics you want to hear about, please let us know. We are here to help.
Thank you very much. Appreciate it.